Everybody was following the banking crisis when Silicon Valley Bank and Signature Bank collapsed because of their underwater assets. But these quote underwater assets have not gotten better for many other banks. In fact, they've gotten worse, and most people are ignoring this. Take a look. When the banking crisis was happening in the early part of 2023, there were two main triggers for this. Number one was loans defaulting, and number two was that banks couldn't go out and raise more money. Starting with loans defaulting, banks like Silicon Valley Bank were in the business of lending money to startups, and startups were starting to see more struggles and pains because of the higher interest rates, so some startups were seeing their loans default. Now, when the banks were losing money on these loan defaults, generally what they would do is go out and raise more money. But the problem was they couldn't do that because they were so underwater on a lot of these assets. And because they were underwater on their assets, these banks couldn't go out and raise more money, which put them in this credit crunch, this credit risk. And then this fueled banking issues, so people pulled their money out of the banks, which ultimately led to the bank collapsing. The question that I want you to understand here is, what were these assets that banks were underwater on, and what has happened to the value of these assets since Silicon Valley Bank? And the assets that so many banks were underwater on were bonds, more specifically Treasury Bonds, aka loans that the banks make to the government. The United States government allows people and entities to lend money to the government. This is called a treasury. So if you go out and you buy a treasury, you are lending money to the government, and one of the largest holder of treasuries are banks. So banks take some of their extra cash and they lend their money to the United States government. But what you want to understand about this is that bond prices are inversely correlated with interest rates, meaning when interest rates go up, bond prices go down. The reason why you have to understand this is because between Silicon Valley Bank collapsing and today, interest rates have gone higher and higher because of the Federal Reserve Bank. And so naturally, that means that bond prices have fallen further. This is a chart that Ray Dalio published on his LinkedIn page showing that banks own a near record amount of bonds on their balance sheets. See, when interest rates were near zero during 2020 and 2021, banks were going out and lending a lot of money to the United States government, meaning banks were going out and buying a lot of these bonds at near zero interest rates. Well, now interest rates are much higher and banks are holding on to a lot of these bonds that are now underwater. And the question is, what does this mean? If we go back to the whiteboard, remember there were two triggers that led to the previous banking crisis. Number one was the loan defaults that banks were seeing, and then number two was the credit issue. When you have these underwater assets, that makes it more difficult for banks to go out and raise more money because, well, if you own a home that you're underwater on, banks are not going to want to lend you more money because you're underwater on your assets. So if banks are underwater on their assets, on their bonds, it's more difficult for them to go out and raise more money. However, that's not an issue so long as you can make your payments, right? If you're underwater on your home, but you can make your monthly payments, no big deal. And that's why you have to also understand loan defaults because, well, if people are making their payments to the bank, then they don't have to worry too much about this because they don't have to worry about trying to go out and raise more money. Not to mention the fact that when the banking crisis was happening in the early part of 2023, the FDIC worked with the Federal Reserve Bank to create an emergency lending program to allow banks to go out and raise money even if they had these troubled assets, their underwater assets on their books, to allow banks to continue to stay afloat. The problem with that now is you have these banks that are able to go out and raise more money, aka borrow more money, but that also means higher costs for these banks because now not only do they have to worry about paying these higher fees for these new loans because they're underwater on their other assets, but many banks, especially regional banks, are also facing the issues of cash outflows and higher expenses. Why did people move their money out of regional banks? Because they were worried about these banking crises, so they were pulling their money out of these regional banks, which means that these regional banks had less ability to make money. Plus, you have the issues of people borrowing less money because of the higher interest rates, and now because of the slowing economy, you can start to see the higher defaults can also lead to these profitability problems that more and more regional banks are facing. That poses this issue right here, where if banks are not making enough money to continue servicing their costs, that could push more and more banks into this credit crisis because sure, the Federal Reserve Bank can print an unlimited amount of money. However, you want to understand that there are risks happening here behind the scenes in the banking sector because while you're not seeing that major crisis that we were seeing in the early part of 2023, there are still pains in the banking sector. And this is where I want you to be more financially educated and understand that there are red flags to the economy. Yeah, the Federal Reserve Bank patched the issue. They put a Band-Aid on it. They created a new lending program that if you are a bank that If you're struggling with operational costs and if you're underwater in your assets, no worries. You can go out and borrow billions of dollars from the Federal Reserve Bank. This allows you to stay afloat. But if you continue to see cash outflows, if you continue to see lower revenues, if you continue to see higher expenses, especially with these higher debt costs, eventually, that's going to lead to more breaking points. And this is happening simultaneously with changes happening in the economy. We've already seen student loans restart. We've already seen changes in spending habits. We've already seen the impacts of the higher inflation. We're still seeing the impacts of the higher interest rates. So if we start to see spending slow down, if bank revenues start to slow down, especially the regional banks, this isn't affecting the bigger banks as much because a lot of people have moved their money out of regional banks into the bigger banks out of fears of banks being shut down. But you can start to see now where this would pose issues for some regional banks. And the reason why I want you to understand this is because, well, every movement in the economy creates opportunity. But for most people, it creates panic. When most people hear banking crisis, they hear panic, they freak out, they get worried, they get scared. Well, some people see opportunities. And so what I want you to do is be a more financially educated investor. That means, number one, understand what's happening in the world. Number two, understand the risks that are out there. And number three, being able to seize opportunities. Because you can only really seize opportunities if, number one, you are financially educated. Number two, you are prepared to be able to capitalize on opportunities. What does it mean to be financially educated? Well, that means you understand how to use your money and understand how to invest your money. It means understand how to find opportunities. I'm not going to go too deep into that in this video, but my team at Briefs Media put together an amazing ebook titled How to Build Wealth as an Investor that walks you through that. First, from the basics of how do you build your mindset as an investor, to how do you save your first couple $1,000s, to how do you start investing, how do you find opportunities, how do you generate cash flow, what are different ways that you can invest your money, to how do you spend your money, how do you earn more money, and how do you protect your assets. There's a ton of value in this ebook. You can download this ebook for free. All you got to do is click the link down in the description below or go to briefs.co/ebook. And then being financially prepared is all about having the means, having the capital, having the cash to be able to actually capitalize, meaning buy investments that you see a good opportunity of. And that means you have to start preparing when times are okay. That means you have to put money aside to protect you and also put money aside to be able to capitalize on opportunities, because you can see the best investment opportunities in the world, but if you have no money to be able to capitalize on the opportunity, it doesn't really do you any good. And we have a lot of different changes coming into 2024. Number one is we have the changes with student loans. Number two is we have the impacts of the higher interest rates. Number three is we still have high inflation. Number four, you're seeing a slowing job market. And number five, we have a lot of debt that's going to start readjusting in 2024 and 2025 for corporations and commercial landlords. And so that's going to have other impacts in the economy as well, not to mention the political issues. We have geopolitical issues happening in the world, and we have an election coming in 2024. All of these things are going to impact the economy, which is why I want you to be more financially educated and stay on top of what's happening. That way you can win no matter what's happening in the economy. Wells Fargo just put out a warning saying that they believe a recession is coming to the housing market because of the higher mortgage rates. Now, they're not the first bank to say this. Bank of America also in October put out a statement saying that they believe there's going to be more turbulence coming to the housing market. So what I want to do in this video is three things. Number one, I want to go over what is this 1980s style